Quick question, and I want you to actually answer it, not just read past it. Are you a better than average driver? If you said yes, you're in good company. Roughly 80% of people say yes to that question, which is mathematically impossible. Half of all drivers must be below average. That's what average means. This is not a driving study. It's a window into one of the most expensive cognitive biases in existence, one that researchers have documented in pilots, surgeons, lawyers, CEOs, and most consistently of all, investors. The more someone knows about financial markets, the more certain they become in decisions the data says they should be cautious about. The more they trade, the worse their returns get, and the smarter they believe they are, the more money they tend to lose. This is the overconfidence effect, and it is almost certainly affecting your portfolio right now. Meet James. James is 41. He has been investing since he was 26. He reads earnings reports. He follows the Fed. He understands price-to-earnings ratios, free cash flow, and the difference between a moat and a marketing claim. He has more investing knowledge than 95% of the people he knows, and he is aware of this. It is, quietly, a source of pride. For the first few years, James kept most of his money in index funds. Simple, boring, automatic. Then, as his confidence in his own analysis grew, he started moving more into individual stocks. He began trading more actively, rotating out of positions he'd read were overvalued, rotating into ones he'd identified as undervalued. His research was thorough. His conviction was high. Over a 5-year period, James's actively managed portfolio returned 9.2% annually. Over the same 5 years, the S&P 500 index returned 14.8% annually. James had spent hundreds of hours researching, analyzing, and trading. He had beaten most of the people at his dinner table in conversations about markets, and he had underperformed a fund that required no research, no trading, and no conviction whatsoever, just the decision to buy the index and leave it alone. James is not a cautionary tale about stupidity. He is a cautionary tale about knowledge, specifically about what knowledge does to confidence and what confidence does to returns. Overconfidence in investing is not simply feeling good about a stock pick. It is a documented cognitive pattern with 3 distinct components that researchers have identified across decades of study. The first is overestimation, believing your abilities, knowledge, or accuracy are higher than they actually are. The second is overplacement, believing you are better than most other people at the same task. The third, and most dangerous for investors, is overprecision, believing that your predictions are more accurate than the data justifies. All 3 are present in James. He overestimated the edge his research gave him. He placed himself above average among investors, and he believed his market predictions were more reliable than they were. But the most important evidence on overconfidence in investing doesn't come from a psychology lab. It comes from a study of real money, real trades, and real returns. In 2000, finance professors Brad Barber and Terence O'Dean published a landmark paper called "Trading is Hazardous to Your Wealth." They analyzed the actual trading records of 66,465 households at a large brokerage firm over a 6-year period. And what they found should be required reading for anyone who has ever bought or sold a stock. The households that traded the most, the ones who were most active, most confident in their analysis, most certain about their timing, earned 11.4% per year on average. The market returned 17.9% over the same period. That is a 6.5 percentage point annual gap. Compounded over 30 years, that difference on a $100,000 portfolio is the difference between $1.9 million and $5.3 million. Not because of bad luck, not because of a crash, because of overconfidence and the excessive trading it produces. Barber and O'Dean's conclusion was direct. Trading is hazardous to your wealth. And the driver of excessive trading, in their analysis, was not greed. It was confidence, specifically, the belief that one's own analysis was more accurate than it actually was. The investors who traded the most lost the most, not because they were wrong about stocks, because they were too certain they were right. In 1999, psychologists David Dunning and Justin Kruger published research that introduced a curve that has since become one of the most widely discussed and most misquoted findings in psychology. Their core finding: people with limited knowledge of a subject consistently overestimate their own competence. And more unsettlingly, as people gain a little more knowledge, their confidence often rises faster than their actual ability. It is only after significant expertise is accumulated that confidence and competence begin to track together. In investing, this curve is devastatingly common. Someone who knows nothing about markets doesn't trade much. They put money in a savings account or a simple fund and leave it. Their confidence is low, but so is their error rate. Then they learn something. They read a few books. They follow a few analysts. They have a stock pick that works. Their confidence rises, and so does their trading activity. They are now in the most dangerous place on the Dunning-Kruger curve. They know enough to feel certain, but not enough to know what they don't know. This is where James lives on that curve. He has moved past the early ignorance stage. He knows more than most, but he has not yet reached the expertise level where he understands the full scope of what he is competing against. Professional funds with billions in research budgets, algorithmic trading systems operating in milliseconds, and the cumulative wisdom of every other market participant also trying to find the same edges he is. The painful irony of the Dunning-Kruger effect in investing is that the more you know, the more you trade, because every new piece of knowledge feels like an edge. And the more you trade, the more fees, taxes, and timing errors erode your returns. The knowledge doesn't destroy the returns. The confidence it produces does. And here is the most uncomfortable part of this. The investors who are most resistant to hearing it are, by definition, the ones who most need to hear it. Because overconfidence, by its nature, protects itself. It reinterprets underperformance as bad luck. It attributes the market's gains to noise. It finds reasons why this time the analysis is sound. This is not a character flaw. It is a cognitive architecture. And like all the biases in this series, the solution is not to overcome it. It is to design around it. The goal is not to stop being confident. Confidence in a sound investment thesis is appropriate. The goal is calibration, aligning your level of certainty with what the evidence actually supports, rather than with how much you know about it. 3 strategies, all of them used by the investors and researchers who have spent the most time studying this problem. Strategy 1. Track your actual returns in writing. Most investors have a vivid memory of their winning trades and a blurred memory of their losing ones. This is not dishonesty. It is how human memory works under loss aversion, which we covered in episode 1. The result is a systematically inflated sense of one's own track record. The first calibration tool is a trading journal, not for analysis, but for accountability. Every trade logged, the thesis, the entry price, the exit price, the return, and whether the thesis played out. Reviewed quarterly, this journal does something no amount of further research can do. It shows you your actual hit rate, not the one you remember. Most people who start this practice discover their track record is significantly less impressive than their mental highlight reel suggested. That discovery is not demoralizing. It is calibrating. And calibration is what separates a confident investor from an overconfident one. Strategy 2. Ask, what would have to be true for me to be wrong? Overconfidence is structurally self-confirming. The more you know about a position, the easier it is to construct reasons it will succeed and dismiss evidence it won't. The correction is not to look for more confirming evidence. It is to actively interrogate the disconfirming case. Before acting on any investment conviction, Force yourself to answer a single question in writing. What would have to be true for me to be wrong about this? Not what might go wrong in general. What specific condition or data point would invalidate your thesis? If you can't answer that question clearly, your conviction is not based on analysis. It is based on confidence. And in investing, confidence without a clearly defined failure condition is the most expensive kind. Strategy 3. Use the index as your benchmark, every time. The final strategy is the simplest, and the one most actively resisted by people with high investment knowledge. Set the relevant index as your default benchmark, not against your own previous returns, not against inflation, not against your neighbor's portfolio, against the index you could have bought instead. This matters because overconfidence is comparative. It's not just, I think I can make money. It's, I think I can make more than the alternative. And the alternative, a passive index fund with zero research required, is a formidable competitor. It has no behavioral biases. It doesn't overtrade when confident. It doesn't hold losers out of pride or sell winners too early out of fear. When you measure yourself against the index consistently, over time, the picture becomes clear. Some people genuinely outperform. Most don't. And the ones who do, over long periods, tend to trade significantly less than the ones who think they will. This is not an argument against active investing. It is an argument for knowing, with evidence, over time, whether your active investing is actually generating an edge. Most people have never checked. Most of those who have are surprised by the answer. James still invests. He still reads earnings reports. He still follows the companies he believes in. But 18 months ago, he started a trading journal. And 6 months after that, he ran the numbers on his 5-year track record with the same rigor he applied to his stock picks. What he found wasn't catastrophic. It wasn't negligent. It was simply this. He had worked harder than almost anyone he knew at this, and produced a result that a passive index fund had beaten by 5.6 percentage points a year, every year, without trying. He didn't stop active investing, but he stopped believing his returns were proof of skill, rather than a mix of skill and something much harder to measure: luck, timing, and a decade of rising markets that made a lot of people look smarter than they were. The most expensive words in investing are not, "I was wrong." They are, "I knew I was right." Because the second set of words is what keeps you in a position past the point where the evidence has moved on. Confidence is not the problem. Uncalibrated confidence, confidence that has never been stress tested against actual returns, actual outcomes, actual disconfirming evidence, that is the problem. And it is solvable. Not by knowing less, by measuring more honestly. In the next video, we're looking at something that goes deeper than investment decisions, all the way back to where most of our financial beliefs were formed in the first place. It's called the money script. It's the set of unconscious beliefs about money that most of us absorbed before the age of 10, from the conversations our parents had, the arguments they didn't have in front of us, and the financial decisions we watched them make. And research shows that those early scripts are running in the background of almost every significant financial decision we make as adults, without our awareness and without our permission. If you've ever done something financially that you couldn't rationally explain, that video will explain it. Subscribe so you don't miss it. And if this video shifted something for you, share it with someone who's been very confident about their portfolio lately. I'll see you in the next one.